Dr. Adrienne Many, thanks for your time this evening. Talk us through what exactly the latest figure is saying about the rate of price increases in the country.
Well, the number is very subdued. As you pointed out, it's the slowest increase in 8 years, with prices rising by an average of 3.7% over the past 12 months. This is very close to the bottom of the Reserve Bank's target of 3 to 6%. And I would argue that more than anything, it talks about a very, very sluggish economy, that there's just an absence of demand to push prices higher. And you can infer that if you look at the different categories that make up the consumer price inflation basket, is almost across the board. Prices are very subdued. And if you take that at face value, it suggests that we could be in line for an interest rate cut tomorrow, if you take that 3.7% number into the Monetary Policy Committee meeting.
You do mention that it's subdued almost across the board, but what were some of the factors that did contribute the most to the figure that we saw?
Well, one of the numbers that's been driving hard for quite a while has been food price inflation, and the other has been administered prices. And administered prices would include the likes of electricity as an obvious line item. And those have sat down. It remains the case that food price inflation is a contributor. It's a very large part of the basket. But really right across the board, there's no single number that you would sort of point to as being the prime culprit in terms of driving inflation of 3% or dragging it down to what by all counts is a very subdued number.
Given the sluggish growth that you've just mentioned, do you think this trend is set to continue? Should the SARB react now before we see a continuation?
I think that's an important point, is that the SARB doesn't look at what the most recent number was, but rather the South African Reserve Bank is forward-looking in their deliberations about interest rates. And so their decision will be guided not so much by the fact that you've got this very tame inflation figure, but rather what they expect inflation to look like in 12 and 18 months' time. And here, the South African inflation environment is very susceptible or vulnerable to unexpected currency weakness or oil prices. And both of those are, to a large extent, outside of the hands of the South African Reserve Bank. We've also got, by historical standards, a very cautious central bank. And I think that this is a standout feature of South Africa's monetary policy. It's one of the factors that puts us in such strong global standing. So although you could make an argument at face value for an interest rate cut tomorrow, I'm not sure that we will get sort of an early Christmas gift in the form of a rate cut.
Yeah, I mean, how much of a factor would the global interest rate cycle impact the decision of the SARB? We did just see China making its decision, and we're seeing some trends in the European Union as well as the US.
Absolutely. The theme globally is towards softer rates. And indeed, in some advanced economies, you have negative rates. Japan and Germany are the standout examples. The global giant, the United States, has been cutting rates for some time. And admittedly, they probably quite close to the bottom of their cycle, if not at the bottom. But it leaves an outcome in which South Africa's real interest rate, which is our interest rate minus the inflation rate, gives us one of the highest real interest rates globally. And that's an attribute that has led to a lot of money coming into South Africa. It's an attribute that makes foreigners almost natural buyers of South African government bonds, even against the backdrop of ratings agencies downgrading South Africa. So if we were to follow the global theme or trend, it would be certainly for a rate cut at tomorrow's announcement. And that's another factor that, I think we have to put in. I'm going to give you a real economist's answer here and suggest that as it stands, this is a 50-50 call.
And then very briefly, Dr. Adrian Saville, I must ask you, we saw the AG report today showing that the audited state-owned entities, none of them got clean audits. I mean, is this the way, is government intervention the way to go, giving them bailouts? Is it the way to go given these unclean audits? And how would the likes of S&P react to that on Friday?
The call for effective financial and operational or financial functioning and operational performance of the state-owned enterprises was there was a clear call for this in Moody's statement a few weeks back. And certainly the other ratings agencies, as well as investors more broadly, are looking to this as a cause for confidence and clarity in South Africa. The track record and the recent indicators don't shower the state in any form of glory. It puts a big question mark over the capacity of the state to run these enterprises. This is not a case for the private sector then is the solution to all of this. For every case of state-owned disarray, I think we can find examples of private sector disarray. The call is for, I think, a clear admission of the extent and acknowledgement of the extent of the problem, and then clear action plans as to how this is going to be remedied and resolved with explicit time horizons and targets. I think that's the ask from these state-owned enterprises. That's not a case of, well, more money and the problem will be solved. That certainly isn't the remedy.
Yeah, Dr. Adrian Saville, many thanks for your insights there. He's the Chief Executive at Cannon Asset Managers.